Ian, first, I want to welcome everyone for joining us. Thank you so much. We are excited to have everyone here for a brief webinar on ESG investing, values, terminology, and your portfolio. My name is Meg Maston. I'm the Chief Relationship Officer at CoPeace. And today's discussion is going to be led by two phenomenal individuals who are experts in the field. I'd like to introduce both of them. First, I'm going to start with Pete Pittman. He is a registered financial advisor with Aspen Wealth Management. And also next, Craig Jonas. He is the founder and CEO of CoPeace, an impact holding company. We're going to go through a brief presentation with Craig and Pete, and that might take 20 plus minutes. And then we're going to have a nice open discussion, open for questions and answers. You're welcome to just unmute yourself and ask the question outright. You can also send me a message with a written question, whatever you prefer, but we'll do that all towards the end, and we welcome any and all questions. We are going to record this webinar and send it out. So if there are others that you would like to share this with, we'll have that available to you momentarily after the call. And lastly, I just want to mention that all of the information provided today is strictly informational, educational only. It is by no means intended to be financial advice, and we are not trying to sell any of our services and whatnot. So just wanted to put that out there ahead of time. So thank you again for joining us. And with that, I'm going to turn it over to Pete and Craig.
Thanks, Meg. Hey, everyone, Pete here. Many of you that are on the call know my background. First 20 plus years of my career with Wells Fargo. Transitioned a couple of years ago to the independent channel, most recently with Aspen Wealth Management, where our focus, in fact, 100% of our client money is invested in sustainable or responsible funds. So I'm excited to go a little deeper into what that means and share a little bit more about the history of ESG and where we are today and what it looks like going forward. And really excited to have my friend Craig on the call to provide additional perspective in the private market space, not just public markets. Craig and his company are doing some really incredible work in impact investing. So happy to have him on the call with me as well.
Thanks, Pete. Looking forward to it. And I think you may be, maybe people know some of your background, but they don't know all your background because it sounds like we have an interaction that was preceding everybody else when you attended the Clem Haskins basketball camp back in the day. And I was coaching there, so we were both MIAC athletes from a small colleges in Minnesota.
Yeah, I'm still convinced you probably yelled at me a lot for missing layups, and we just don't remember it.
I think that probably did happen. The Clem Haskins taught us that thoroughbreds will bite you, so we were supposed to make sure that we took care of the great special athletes, and I think we're in that category.
So thank you everyone for joining. We're gonna keep this pretty high level. The presentation, we're gonna, like Meg said, try and cover most of it in about 20 minutes, and then leave the next 15 or 20 after for more granular, detailed questions that you might have. So let's jump in. ESG, just a little bit of a background. A lot of, this term has become much more popular in the last couple of years. I think most investors, professionals are now familiar with what it stands for. Most people don't know where it came from. 2006, the United Nations, the Principles for Responsible Investment, basically coined the term ESG as a way to identify additional stakeholder risks, or what I will often call off-balance sheet, off-income statement risk to a company, anywhere from supplier diversity to employee engagement to community affairs to the main one that I think most people think of today as the environmental risk that individual companies face. So, social impact investing goes back to the 1800s, to the time of the Quakers, and it's had a series of evolution over the last 100 plus years. As recently as the 1970s and 80s, it was coined socially responsible investing. SRI. ESG, like I said, was more of a mid 2000s, and I would say it's only in the last 5 years that it really became more mainstream, and where you're getting a lot of people starting to inquire about it and what it actually means. So again, think of it as stakeholder capitalism versus shareholder capitalism. It was Milton Friedman in 1970 that had the Friedman Doctrine that basically said the sole responsibility of the corporation was to its shareholders. And, in the last 5 to 10 years, people are starting to question that more. Looking at all the criteria that a corporation, all the impact that they have as listed here. Again, oftentimes we think of the E in ESG, the environmental side, but in the last year, I think the social side has become much more prevalent with race relations and gender diversity and things of that nature. Again, those of you that know my background with Wells Fargo are familiar with the governance side, which was in 2016, Wells Fargo was embroiled in a fake account scandal that really came down to lack of governance from a corporate standpoint in what the employees were doing. So that's more of the G side of ESG. Again, a lot of these things aren't picked up in the income statement or the balance sheet, but they very much are probably reflected in a corporation's performance and overall standing in the community as they try to grow their business.
And I would say that's a great overview, Pete. I would say that as we begin to uncover more information to inform us on the multiple bottom lines, with that some of these things are starting to percolate up, and I think the ESG measurement and the ESG driven stakeholder value is becoming more and more important for us at CoPeace. We are actually legally a public benefit corporation, which legally protects our stakeholder community over just the shareholder value. So I think that's an important evolution of where we're going. I would say that historically, even at my age, I used to dabble in kind of socially responsible investing, and I was fine, not getting, giving up some points and not getting the same kind of return, but that doesn't lead us to where we need to go. So I think it's great that we're starting to understand the more inclusive bottom lines and how that affects the entire picture. So now we're not okay giving up points. We want to make sure we are competitive in the way we treat our returns.
Yep. And Craig, to that point, 2020, we don't have a slide to it, but on our blog, we actually point to the outperformance of ESG funds last year. So people are no longer having to give up return, like you said.
Yep.
So these terms, we kind of do a little alphabet soup here. High level ESG, again, environmental, social, governance. SRI, socially responsible investing, decades ago, kind of was relabeled recently to sustainable, responsible, and impact investing. I think they figure that captures more of what is being done out there. TBL, or triple bottom line, people, planet, profit. Again, looking at all stakeholders, not just the bottom line of a company. SDG is the Sustainable Development Goals. There are 17 of them that the United Nations put out. And when you start thinking more of impact investing, Craig, like what you guys do, a lot of investors are looking at the 17 SDG goals and trying to identify that those that are most representative of their personal values, and then trying to direct either philanthropy or investment dollars in that direction.
Yep.
Do you want to comment a little bit more on this?
So for both the SDGs and kind of the evolution of impact investing versus ESG, we're seeing it much more in the vernacular and then public awareness. I think internationally, we've done quite a bit globally, and the SDGs have had a better foothold, but it's coming here, and I think it's nice because it allows people to, like you said, associate their values with some of these UN Sustainable Development Goals, and and impact investing kind of tries to take it to another level, so that we are directly investing in companies that are trying to show a strong return and have social or environmental impact. So we're, this continuum is something that is showing real evolution.
Yeah, here you see the growth of ESG. I think it's clearly a hockey stick, as you can see. The number I like to say, last year ESG funds accounted for a quarter of all inflows into the public markets. Compare that with 1% in 2014, and that just shows you the significant increase in just 5 years. Market validation, a lot of this is driven by corporate boards, and I think high level, the Business Roundtable came out a couple of years ago and talked about stakeholder capitalism. But from a bottom up perspective, I think you're seeing it more and more with the younger generation in where they choose to shop, where they choose to work, and how they choose to invest. And they're much more concerned with investing aligned with their values. You also see this more with females that are inheriting money from their spouses that maybe passed away and are not satisfied with just total market exposure. They want to be more intentional with those dollars.
Yeah, well said, Pete. I think we're so close to it, we don't realize that this is still news for most of our community that we're talking to, and we've done a couple of focus groups, and it's real. I mean, the young people and women and people who care about the future have access to information. They're not okay investing in some of the mutual funds my parents invested in, and they were very socially justice motivated. And when I told them that, hey, your mutual funds have 20% oil and gas, 10% for-profit prisons, 10% firearms and tobacco, they were like aghast, and they're like, no. And I was like, yes, but you're not the only one. Everybody has the same type of mutual fund composure. So that's not okay anymore for a lot of people. And I think with access to information, that is driving some change.
Absolutely. Here are some more numbers on the future of ESG. I think that last one, 45% of asset managers say they began ESG strategies in the last 4 years. There's kind of a gold rush going on right now. I think you're seeing just incredible hype, and basically every money manager is trying to stamp an ESG label on their fund to help drive inflows. Craig, do you know how many sustainable funds there were available to U.S. investors last year?
Okay, I would say it depends how you count them, I guess, but 15. No, it's way more than that.
It's just a little low, 400.
Yeah. No, sorry. Yeah, 400. But I was going to add to your point that, I guess it's consistent, because maybe it's 15 that I would consider genuine, because there's so many of them are doing what you said is kind of greenwashing or impact washing and kind of putting a PR spin. And if you look under the covers again, they're all kind of the same, and many of them are not true, what we would consider true ESG funds or ETFs. So I think one of the things that we're trying to do, and I think what Aspen Leaf's trying to do, is make it real and try to uncover these things that are real, the 15 that might count out of the 400.
Well, and you raised a really good point. We get that question all the time about how clean is the fund I'm investing in. We kind of refer to it as good, better, best. And a lot of these ESG funds we do view as good. I mean, they're screening, and they're tilting to companies with higher ESG data scores. But those could still include fossil fuel companies or other for-profit companies that you don't agree with. Better is you can find those funds that are really excluding a lot of things that you object to. And then the best that I've started talking to clients about more and more is what we call custom direct indexing. So you can create your own custom index as an investor from the universe of stocks and basically exclude different sectors or industries that you find offensive or you don't want to invest in. And you can also black label certain companies that you don't agree with their practices. So it is a range, and here's the spectrum of investing. So it kind of leads into where all the money is flowing. You know, on the far right is just traditional investment that we have known for 100+ years, which kind of, you know, gives up to responsible investing and then impact investing all the way over to philanthropy and grants. And you're just seeing, again, today, there is such a wide range of dollars and how it's being deployed to, again, not just for profit, you know, generate a return for the investor, but what is the additional social or environmental impact of that dollar? I'm going to let you run with this one. You guys, when you think of impact investment, there are publicly traded securities that do impact, but I think more often than not, people think of impact as much more targeted, and you can do that probably more at the private level. So,
yeah, that's what we think too. Thanks, Pete. Yeah, so impact investing is much more direct. You know, we're seeing. At CoPeace, we've already evaluated over 150 businesses for us to consider investing in, and there's a lot of good news, a lot of activity that people are showing, you know, kind of awareness of how to play the game in a way that we would deem appropriate. Well, one of the reasons we don't invest is often the math is lacking, but we're trying to find, you know, purpose plus profit. We consider kind of the Moneyball approach more than a VC 100-time return approach. We're looking for singles and doubles, and internally we say, you know, zebras fix what unicorns tend to break. So we think there's some danger in, you know, some of the activities that have happened traditionally. Impact investing is not the negative screening that Pete was talking about and some of the other philanthropic efforts that are going on. We think that it's important to have a strong return so that companies can continue the influence and continue the positive impact. We've actually been approached by foundations of late that have been fatigued by their approach. That, you know, they've kind of been giving, and then oftentimes they'll look and their funds have been depleted in one way or another, and they're starting to consider using program-related investments and some other ways to dabble in the impact space so that they can have the impact but also have the return. And I know it sounds like an idealistic idea, but it's a good business decision right now to care about the long-term future of our world. So we like where this is going. I think both Aspen Leaf and CoPeace are in a good spot and have some good timing on our hands.
Yeah, real quickly on impact investing, I read recently that over $1 trillion now is dedicated to impact, and it's projected to grow at 250 billion per year.
Wow. I'm glad you didn't test me on that one.
Yeah, it's a significant amount. The other thing I think about is, you know, like you were saying about, you know, putting the money to, you know, into a company that can generate profit, and that there shouldn't necessarily be a misalignment for what's good for society or what's good for the planet can also be good for business.
Absolutely, it has to be. I totally agree. It has to be. Some of our initial investments are, you know, we're seeing a lot of people get caught up in the measurement of the impact and the measurement of the ESG. And for us, we kind of coming from the sports background to bring up the Clem Haskins basketball camp again. We just kind of look at everything on a case by case basis and then try to be extremely transparent about telling the story of the impact. Some of our initial investments, for example, are in companies that are bringing power and cloud storage and 5G to communities that don't have access to the grid, or that are taking hazardous waste that's leaching into the groundwater and converting it to energy. I mean, if you look at it, there's clear impact going on there, and those are the type of companies that we like.
Great. Here are the 17 sustainable development goals for those that are not familiar. You can read through those, and again, we're working with a lot of clients that will share this and, you know, ask them which is most representative of your background or your current values, your beliefs, and try to align their investment portfolio with that. There's one of the funds that we use in our portfolio actually tracks this, social development index, and it's a public fund. But again, more often than not, we see SDGs aligned with really direct crowdfunding, impact investing, and philanthropic dollars.
Nice.
Just, again, at Aspen, from a financial planning perspective, we think of how do you allocate that capital that you have? And we really spend a lot of time focusing on personal values. It's built into the ethos of our company that we want to work with people on a deeper level to really understand what drives them. Everybody wants to be financially comfortable and successful, but everybody at their core has something else that's driving them. And to really get deep into what those values are is critically important for us. One thing I wanted to mention, our company was recently certified last week as a certified B Corp. And Craig, I'm going to let you touch on what public benefit corporation, B Corp, if you could give people a little bit more insight into what that means.
Yeah, well, first of all, congratulations on navigating that. It's a very stringent process to become a certified B Corp. There's quite a bit of confusion in the marketplace on that as well. So the legal structure of a public benefit corporation is the legal structure that we are using. It's very much like a C Corp, but it has in our bylaws the protections that protect the stakeholder community as well as the shareholder value. So it's a legal structure. Ours is based out of Delaware. Certified B Corp is a stamp of approval that you're walking the walk in the ESG impact game, and that you go through an extremely stringent process of all kinds of different factors that show that you're real. It's not an easy process, and it's especially difficult for companies in the finance realm. So the fact that Aspen Leaf and CoPeace are both certified B Corp corps makes us quite unique in the space.
Definitely. So capital allocation, again, we'll work with our clients, start with the values, but understand how the money is tied up, liquid, illiquid, whether they need it for short-term or long-term. Again, we're talking here today, the difference between private and public investments. Risk tolerance is a huge piece, and just the alternative side, which is really understanding what your options are. And it's not just stocks or bonds.
Yeah, I think that's where we tend to play kind of in that alternative space, and we're fine with that.
So I think that was about 20 minutes. Again, very high level. We could go down rabbit hole and talk for hours about individual issues or concepts or terms, but we really wanted to hit the high level today and then open it up to the community for questions.
Thanks, Craig and Pete. Great presentation. Good knowledge, good information. I hope everyone gets some value out of this, this time spent together. So as Pete mentioned, we'd love to open it up for questions. We have a small enough group that I feel if you want to just unmute yourself and jump in and ask, or you're also welcome to send questions either to me or to the group through the chat, whatever you prefer. But I will give everybody a minute and see who has a question.
I can start us off. So hi, everybody. I'm Jenny Desmond. I'm the Development Director at Intercambio Uniting Communities in Boulder, Colorado. And we are getting ready to launch a endowment campaign. So we want to raise $1 million, trying to decide where to invest it. And we're really struggling with ESG, and with that, is that going to be a higher priority than making more money? Now, I know that ESGs have done well in the last few years, but with it being so new, I really struggle with, like, how do I fill the donors' intentions when it's so many donors?
Go ahead.
Yeah,
Pete.
let me
start.
Yeah, I'll try and take a stab at that. What's interesting about ESG is you can now pretty much apply that to every asset class. So historically, people thought if I wanted that ESG exposure, I was going to give up exposure in other areas. And now the markets are pretty well adapted, and you can get full coverage across every asset class, invest for those specific goals that an endowment has, and just to have that ESG overlay. So oftentimes people think if you add that ESG, you're going to have a significant tracking error from what you would traditional investments. And that's not really the case. If you kind of dive into some of these funds, they do a really good job of screening, and they're using data to really tilt in favor of companies that have better ESG scores. But in doing so, they're not creating significant divergence from what a traditional fund would look like. So that's where, back to what we said at the beginning, I don't think investors have to worry about sacrificing return today like maybe they did in the past, where they thought they were excluding so many things.
And I would even add to that to argue the other way around, so that not only are you not sacrificing returns, but you've got a chance of more of an upside. I think we've been surprised on our side that people who've kind of done more research and due diligence on us, we've had quite a few very conservative people and investors come to us and say, you know what, this is real. This is where it's going, and we see problems with what we've been doing in the past. So we're excited about kind of incorporating some of this ESG driven concept. That it's still early stages. So I think, Jenny, that there's different ways to apply the principles, but I think the more and the more knowledge that you have, and the more you can kind of bring it in, it can be helpful for your cause.
Great, thank you.
Good question, Jenny. Thank you. We have a question coming through the chat. Oh, I'm sorry. Go ahead, Pete. Did you have something to say?
Jenny, if you want to hit me up offline, what you're seeing with foundations and endowments is much more targeted investment into ESG with those investments. They're investing for the future. But there are a number that I'm aware of that have started saying, all right, where does that fit in with impacts and program related investing? And saying, okay, not just the money we're giving away, but the 90+% that we're leaving in our portfolio to invest for infinity or for the future. If we're trying to combat a social issue with our philanthropic charitable giving, but the 90% public is going against that, they're seeing more and more conflict there, and they're saying, how can we be fully whole in all of our dollars?
Well said. Well said.
Yeah, excellent. We have a question come in from Chris. First, he said, great presentation. Props to you too. Thank you. How do the fees compare to some of the very low fees for index funds, et cetera, or a managed portfolio?
Yeah, good question. They are definitely higher because you're bringing in additional data. You're bringing in additional, oversight. People always wonder where the ESG scoring and methodology and data comes from. And it's companies like MSCI, Morningstar, Sustainalytics. There's a lot of money tied up in trying to identify company performance in all these different areas. And so, there's been a race to the bottom with investment fees. Everybody's familiar with Vanguard and BlackRock, and now being able to invest as low as, actually some funds I think now are even free. There's no cost to them. What you've seen historically with ESG funds and active management is those could be higher fee products, over 1% in some cases. A lot of the funds that we're using are not free. They're not they're not 5 basis points, but they're only 25 basis points. So the difference there is negligible. And we have, I think we're going to reference in the presentation, a blog post that we did that identified and highlighted the ESG funds that we're using. And again, there's a little additional cost there, but I think it's fairly minimal. And you look at the outperformance, at least over the last 1, 3, and 5 years, and it more than made up for that small increase in fees. So definitely want to reference that at the end of the presentation. But yeah, you do pay more for ESG.
And in our case, we're a holding company, so we're a little bit like modernized Berkshire Hathaway. So we're on a path to continue to grow our portfolio and return our dividends to our stakeholders. So we don't have a cost, but we're a different model.
Very good. Thank you. Thanks, Chris, for the question. Others that have questions, feel free. I had one come in from Jim. With respect to companies that rank high on ESG funds because of their environmental contribution, although they don't perform well on the social or governance side, how do you navigate through that in identifying real ESG companies?
It's a good question. And this is, we're constantly evolving the scoring process. And yeah, you're seeing that a lot. I think people think of maybe like a Facebook that is doing great from an environmental perspective, but it's debatable whether on the social or governance side. And Facebook is included in a lot of ESG funds. There's no perfect solution to this. There's no silver bullet, no panacea. Most of these funds are still scoring. And again, they're tilting to the higher scores. But unless you're doing like a custom direct index or a very, very targeted portfolio, you can't really assume that you're going to get a perfect company. At the end of the day, they're all for-profit public companies that have responsibility to shareholders, and none of them are doing that in a completely, great, perfect way.
Yeah, I think you answered that well, Pete. I would say that so far the E has been easier for us to evaluate and measure. So that that we see the return, we see the real impact. The S and G are also very important. I think as you uncover the 400 funds that you talked about, that you're right, that there's going to be so much similarity in so many of them that that there's an opportunity to use your customized approach to differentiate, because I think it's going to be more and more important. Because if you really look at some of these companies, you really wouldn't think that they should be scoring that high on the ESG. So I think the ability to directly invest in some early stage companies is a nice balance to add to what you're doing.
Very good. Thank you. Others have questions? Don't be shy.
Is my friend Grant he's still on the call?
Yes, I am.
I'm calling you out because you always have good questions.
I always have questions. Yeah, but you mentioned BlackRock, and last night I read something on BlackRock, and I knew that I was going to try to get on this call today, so I paid attention to it. It had to do with them issuing 4% yield bonds. I think they were long-term to fund green projects. So do you think that is a new development, or have they been working on that for a while?
Yeah, that's a great question. And the green bond movement has been significant. More and more dollars going into green bonds that are addressing sustainability, infrastructure, environmental issues. What you're referring to is even more targeted in that it was a traditional loan from all the big banks, but it was contingent that the interest they were paying was contingent on how well they were doing to address social and environmental issues and what their impact was. And I think it was only a basis point. If they were meeting certain targets, the consortium of banks was going to reduce the cost of borrowing by 1 basis point. But I think it was like a $4.5 billion loan or something. I think that is going to become much more common, where companies, and again, the difference is very negligible to BlackRock. So it's good from a public messaging and corporate social responsibility and all that. But I think that's going to be a way that lenders and investors are going to say, okay, we're going to lend you money, and based on certain performance, you'll maybe pay less in your cost of borrowing if you're meeting certain metrics.
Thank you.
Great question.
Very good. Yep. Other questions from our friends on the call? No? All right. Well, with that, I think we'll wrap it up. I do want to give a shout out to the talent behind the curtain, who is our Director of Communications at CoPeace, Jim Crawford. He's out in Pullman, Washington, and he put together the presentation today, as well as running the production of the call, which is not my strength. So thank you, Jim. And huge thanks to Craig and Pete, as well as all of you that joined the call today. We appreciate your time. We know you're busy. If there's anything specific you would like to ask or learn more about, the contact information for both Craig and Pete are listed here on this slide. Please don't hesitate to reach out. We are always always willing to jump on a call and help you out and navigate through this more rather complex landscape at the moment. So thanks again. And